What's going on, everybody? Wise Investments here, and today I'm going to be explaining to you guys what a covered call ETF is. So, right now, I pulled up this article on investorsedge.cibc.com, and I'm going to walk through it to help me explain to you guys what a covered call ETF is. So, covered calls are a potential strategy for stock investors who want to generate income from their portfolio. In recent years, covered call ETFs have become an increasingly popular way for investors to add a covered call strategy to their portfolio. To explain covered call ETFs, let's start with some terms. So, before we kick everything off, we're going to run through some of these terms because if you don't understand what these words mean, then nothing else I say is going to make any sense. So, to start it off, ETF or exchange traded fund. An ETF could hold a variety of stocks, bonds, or other assets like a mutual fund, but trades on a stock exchange like a stock. An ETF enables investors to hold a broad range of stocks or specific investment strategy, for example, without having to select an individual investment. The next term we need to know is call option. This is a financial contract that gives the buyer the right, but not the obligation, to buy a stock at a specific price within a specific time frame. Right? So what the call option itself is, it's a contract that's stating that if this stock rises above this set price, then I will sell it to you at that set price. And the buyer will pay a premium for that contract, and the seller will collect these premiums, and that's how the income is generated inside of these ETFs. But we'll get more into that after. And some of the terms that you're going to need to know related to these call options is premium. This is the amount an investor pays when buying a call option, or the amount an investor receives when selling a call option. Now, these option contracts work somewhat like insurance contracts. That's why they're called premiums when a seller collects the money. So these are, you're basically acting as the insurance company and you're collecting money for selling these insurance policies. Next is the strike price, the agreed price at which the call option holder can buy the stock. Next is the expiry, the last date when the call option holder could buy the stock. And next is assignment, when the call option seller must sell the stock to the call option buyer at the agreed upon price. So, if at the expiry of the contract, this stock is at or above the strike price, then I, the seller, will get my shares assigned. So that means I'll have to sell those shares to that buyer at that set price. And you throw it all together, a covered call ETF. These ETFs sell call options on the stocks in the portfolio and collect the option premium, which could be distributed to investors in the fund. So let's go through how these ETFs work. A covered call ETF starts with a portfolio of stocks and adds an option strategy to generate income. Here's what happens behind the scenes, based on an example of a covered call ETF at CIBC Asset Management. So, the number one step in executing a covered call strategy is to own the stock. You have to own some kind of underlying asset, whether it be a stock, index, or another ETF. The ETF holds a portfolio of high quality stocks, giving you exposure to quality markets. The next thing you're going to need to do is set the strike price. This is going to be the price at which you're comfortable selling the shares. The portfolio manager sets the strike price, a predetermined price at which certain stocks can be sold. Whenever these are sold, you will also be receiving distributions. Next, sell the call option. The portfolio manager sells call options, giving the other investors the right to buy the stocks at the strike price by a specific date. Number four, earn the premium. The ETF collects premiums, a source of cash flow from selling the options. These premiums are distributed to investors as part of the ETF's income. Now, to help you guys better understand the mechanics and how this all works and the implications of these ETFs, I'm going to go through a few different scenarios and how they will affect you. So, a covered call strategy involves holding stocks and selling call options against the stocks. Imagine this situation. A stock is trading at $100. A covered call investor, the call option seller who also owns the stock, sells a call option for $2 at a strike price of $110. The call option buyer has the right to buy the stock if the stock price hits 110. The covered call investor keeps the premium of $2 regardless of what happens to the stock price. Based on this situation, here's how the covered call strategy could play out in these different scenarios. Scenario one, a large move up. So this is what's going to happen if this stock shoots up or this underlying asset shoots up. The covered call investor has capped their gain. The call option buyer could buy the stock at the option strike price of 110, which makes sense if the stock is trading at 120. As a result, the covered call investor is forced to sell the stock at 110. They get a $10 gain on the stock plus the $2 option premium. And this is what's going to be paid out to you in your distributions for a total gain of $12. If they had held the stock without the covered call, they could sell it at $20 and collect a $20 gain. The covered call investor has sold off the upside of the stock above the strike price in return for collecting the option premium. So, in return for this premium, you're giving up some of your upside when the stock shoots up, right? So, up to the strike price, you're still going to get all that upside. But past the strike price, you're sacrificing all that upside because once it passes that strike price, you have to sell the contract or you have to sell the shares. Sorry. So, in a way, whenever you're investing in a covered call ETF, you're putting a cap on your potential upside, but you're generating more cash flow and higher yields by collecting those premiums and the profits from selling the shares. Scenario two, a moderate move up. This is the ideal scenario for the covered call investor. Say the stock ends up at 110. The covered call investor gets a $10 gain on the stock plus the $2 premium for the total gain of $12 without giving up any other upside. Nice work if you could get it. So, this is the best case scenario for a covered call strategy. The stock goes up, but not all the way up to the strike price. So you get to participate in all the upside, and you also get to keep your $2 premium. The next scenario is a down move. The covered call investor has slightly reduced their loss. The covered call investor loses $20 on the stock, but still gets the $2 premium for a total loss of $18. The option premium is $2 regardless of whether the loss is 20, 40, 60. This shows that the covered call strategy could provide a buffer against the small losses, but relatively little protection against large losses. These examples are based on a covered call on a single stock. Things could work a bit differently when an ETF holds, say, 50 or 100 stocks, although the intuition is the same. A moderate increase in the stock price is typically the best outcome for the covered call investor. So essentially, when the stock goes down, you're going to participate in the downside minus whatever you collected for the premium. So essentially, with these covered call ETFs, you're capping your upside to collect premiums, but you're also somewhat capping your downside. So in a bull market, you won't perform as well as somebody just investing in the normal ETFs. But in a bear market, you're going to perform better than the people investing in the normal ETFs. In addition, something that really affects the amount of premium that you're collecting is volatility. So the more the stock is moving, the more volatile it is, the higher premiums you're going to be able to collect. So generally, when there's a big downturn, volatility is a little bit higher. So you're going to be collecting these higher premiums. So it gives you a nice buffer to the downside, but a cap on the upside. A lot of people say that covered call ETFs are more risky, when in reality, they're actually less risky. You're selling some of your upside to cap some of your risk. So the truth is, no, covered call ETFs aren't more risky. They're actually less risky. They're just going to have less, overall gains than just buying the underlying, dependent on how the market moves, of course. So let's move forward here. The potential benefits of a covered call ETF: generate income. Premiums could provide a source of monthly income for the ETF, potentially enhancing cash flow for income focused investors. A lot of these covered call ETFs, they're paying out either monthly, bi weekly, and even sometimes weekly. So this is a great way for you to generate another source of income, supplement your income, offset your expenses, or generate another source of income that you could use to put into other investments. Reduce portfolio volatility. As I said, covered call ETFs actually make your investments less risky, so they're reducing your volatility. Premiums may help reduce the impact of price swings, potentially smoothing out equity returns for risk averse investors in a covered call ETF. Stay invested. The ETF continues to hold stocks without needing to sell, helping growth focused investors stay invested for long-term potential. And support retirement income. Premiums can enhance dividend strategies by offering an additional source of income for covered call ETF investors who are retirees or those drawing down their savings. Potential risks of covered call ETFs: sell off, the upside on a large up move. With covered call ETFs, the portfolio manager has effectively sold off the upside of the stock above the strike price. If the stocks have a sudden large gain in price, the covered call investor would capture part of the gain but would lose any gain above the strike price. Provide limited protection on large down moves. Covered call ETFs may provide a meaningful buffer against small moves in the stock prices. However, the option premium is fixed. As a result, the larger the loss on the stocks, the less protection the premium income provides. Relying on the portfolio manager's expertise. In order to implement a covered call strategy, the ETF portfolio manager has to closely watch the price action of the fund's stocks holdings and constantly manage options as they expire. As a result, there could be gaps between what covered call strategy could achieve versus what it actually achieves. May target high income and end up being very volatile. Not all covered call ETFs target moderate levels of income based on a diversified portfolio of stocks. Some target very high levels of income based on a limited number of stocks, sometimes even a single stock. This may introduce much higher levels of volatility than an investor would like to expect from an income focused strategy, which is usually lower risk. Choosing covered call ETFs. So, yeah, CIBC is going to give their little input there, but when you're choosing covered call ETFs, basically I break it down into two main factors that you really have to understand when you're choosing what covered call ETF to invest in. And those two things you need to understand is the specific strategy that the asset manager is executing. Because one thing about covered call ETFs, they're not one size fits all. and they're all being managed by different people. So they're all executing these strategies in different ways. The thing about option strategies is like there's so many different ways to approach it and ways to go about it. And all of these asset managers are really executing different covered call strategies. So you have to understand what their specific strategy is and how it aligns with you and your investment goals. The other thing you have to be very mindful of is your NAV erosion. What NAV erosion is, well, your NAV is your net asset value. And that's basically the total value of the holdings of the ETF. But what happens is the more that these call option contracts are getting assigned, and the more that you're having to sell these shares, the more the net asset value of the ETF decreases. And as the net asset value of this ETF decreases, that means the value of your shares is going to start to decrease. Now, not every covered call ETF suffers from NAV erosion, but a lot of the ETFs with more aggressive yields, they will suffer from NAV erosion. And you have to understand how to manage that. And just because an ETF suffers from NAV erosion doesn't necessarily mean it's not investable. You have to understand your specific objectives and understand the risks and understand how to employ risk management in those specific situations to mitigate those risks. So, first, I'll touch more on understanding the strategies. Now, me personally, I started off just with my investment journey, just dollar cost averaging into the S&P 500, and then I got into selling options or selling option spreads on the side. So basically another option trading strategy, but I would be investing in the S&P 500 and trading options myself. So I had a good understanding already of how options worked, and I had an understanding of what each of these asset managers were actually doing. And the thing is, for you to execute your own covered call strategy, it's extremely capital intensive because you have to own a lot of shares of these individual holdings. So that's not really a strategy I'm able to execute myself, but covered call ETFs work perfectly for me. So one thing you really need to understand is the strategies that different asset managers are employing. Like we could compare an ETF like HYLD, which is the Hamilton US Enhanced Covered Call ETF, and then USCL, which is the Global X S&P 500 Enhanced Covered Call ETF. Both broad American market ETFs, but both employing a very different strategy, right? Where the Global X ETF, they hold the index itself. So they hold the S&P 500 index itself, and they're selling call options against the index. Whereas in the Hamilton HYLD, they're holding they're holding they're holding a portfolio of other covered call ETFs, and they're selling options on the individual holdings. So different strategies are going to give you different results. Some strategies are going to give you a higher yield, but maybe a little bit more risk. Some will give you a little bit more risk, but a higher yield. Some, different asset managers are also using different portions of the portfolio to sell these covered calls. Some of them are selling calls on the entire portfolio. Some of them are selling it on half of the portfolio. Some of them are only selling it on a quarter of the portfolio. So these will greatly affect your income. These are things you have to learn, you have to research, you have to understand. Another comparison would be something like HHIS, which is the Harvest diversified high income shares, where you could compare that to something like USCL, which is an index covered call ETF, where they're selling calls on the index, whereas in HHIS, they're holding these individual stock ETFs and they're selling options on the individual stocks. This is how Hamilton is able to provide a higher dividend yield while not necessarily being that much more risky than, say, just holding the stocks themselves. So, that's something to consider. Something you have to understand is like, check out these asset managers, understand what their strategy is. A lot of them, they make videos, they do interviews, really trying to explain their specific strategy and their specific objectives. And, based on this, you could figure out which fund would work best for you. The next thing, NAV erosion, right? So, NAV erosion could quickly eat away at your capital, right? So as the covered calls are being sold, the shares are being sold, the net asset value is going to decrease, the value of your shares are going to decrease. So things to consider is, how much of the portfolio are they selling these options on? Because if they're selling contracts on the entire portfolio, your NAV is going to get eroded very fast. But if they're selling them only on 25%, well then that's not going to eat away at your NAV so much. And then there's other things to consider, like are they using leverage, right? Because like a lot of the Canadian covered call ETFs, they use a 25% leverage, which kind of increases your growth potential while also increasing your revenue potential. So that's something to consider. So you have things like MSTY, where they advertise very aggressive yields like 100%. But the thing you're going to have to understand when you're investing in these covered call ETFs is that the higher and more unrealistic the yield is, the greater the NAV erosion is going to be, right? So, like, if you have something with like a 10% yield, a 15% yield, that's modest. That's aggressive. That's aggressive to a regular investor. But for an income investor, that's a modest number. When you start getting into things that have, 40%, 50% yields, those things are definitely going to get eaten away by the NAV erosion. So your capital is just going to shrink and shrink and shrink every year. Even though you're collecting your distributions, your original investment is going to be shrinking and shrinking and shrinking. Now, what a lot of people do is they'll mix these more aggressive yield ETFs that have more NAV erosion with other holdings that are more growth focused to sort of balance out the growth, but still capitalize on the high yields. Just another thing to consider, how each of these ETFs how the NAV erosion is gonna behave, and how that's going to affect your objectives. Everything always comes down to what your specific objective is and how it fits into your overall plan. So I hope that kind of helped you guys understand what covered call ETFs are. It's a relatively new, concept. These products just started coming into the market in the past few years. So it's a great option. Things like this never really existed before. These kind of yields have never been achievable before in history. So, this is an incredible opportunity to take advantage of these kind of things. So, I hope that helped. Hope you got some value out of that. And I'll see you on the next one with more free game. Take care.